Imagine two friends who are both 30 years old, both live in Dallas, Texas, both earn $75,000 a year, and both have managed to save exactly $20,000. Every month, they each invest another $500. Same age, same income, same city, same starting line. But then they make one decision that completely changes their financial future. Ethan decides to build a portfolio of individual dividend stocks. He loves the idea of cash hitting his account every quarter. He wants his investments to pay him. Lucas chooses something much less exciting. He buys a low-cost S&P 500 index fund every single month and barely looks at it. Ask both of them 5 years later who made the smarter decision, and they'll both confidently tell you they did. Here's the problem. They're both measuring the wrong thing. One keeps bragging about the dividend checks arriving in his account. The other can't stop talking about how much his portfolio has grown. But neither one has actually run the full math. And once you account for taxes, dividend growth, reinvestment, expense ratios, market appreciation, and one hidden cost almost nobody mentions, the gap between these two strategies isn't what most people expect. In fact, the biggest mistake isn't buying dividend stocks, and it isn't buying index funds either. The real mistake is believing one headline, one influencer, or one viral social media post instead of following the numbers all the way to the end. So today, we're going to do exactly that. No opinions, no internet arguments, just math. Let's make this as fair as possible. Ethan and Lucas both start with $20,000 invested on January 1st. Both invest another $500 every month. Neither misses a contribution. Neither panics during market crashes. Neither tries to time the market. They're simply following two different strategies. Ethan builds a portfolio of established dividend-paying companies. Think businesses similar to Coca-Cola, Johnson & Johnson, Procter & Gamble, PepsiCo, and other mature companies that regularly return profits to shareholders. His portfolio starts with an average dividend yield of about 3.58%. The companies also increase their dividends over time by roughly 5% per year. Because these are mature businesses, we'll assume their share prices grow about 5% annually as well. Lucas buys one thing, a low-cost S&P 500 index fund. We'll assume a long-term annual total return of around 10%, which is close to the historical average of the S&P 500 over many decades before inflation. His fund charges an expense ratio of just 0.503% per year, meaning almost all of his money stays invested. Already, these two strategies feel completely different. Every 3 months, Ethan sees cash deposited into his brokerage account. It feels like his investments are working for him. His friends ask, "How much did your stocks pay this quarter?" There's something satisfying about getting paid without selling shares. Lucas doesn't get that feeling. He opens his account, sees numbers moving up and down, and that's about it. No quarterly income, no exciting notifications. Just a larger number that occasionally becomes a smaller number during bad markets. One strategy feels productive, the other feels boring. But feelings and math are two very different things. Now, before we move another inch, let's clear up one of the biggest misconceptions in investing. A dividend isn't free money. When a company pays a $1 dividend, it sends $1 from the company's balance sheet to shareholders. On the ex-dividend date, the stock price typically adjusts downward by approximately the amount of that dividend. You didn't suddenly become richer. You simply moved value from inside the company into your brokerage account. That's why economists often say, dividends are a transfer of value, not the creation of value. The wealth comes from owning a profitable business, not from how that business chooses to distribute its profits. That's an important distinction because it changes how we compare these strategies. Now let's see what actually happens after the first year. Ethan starts with $20,000 and contributes another $6,000 throughout the year. His dividend portfolio generates roughly $950 in dividends during year 1. Because he doesn't need the income yet, he reinvests every dollar back into buying more shares. His companies also appreciate approximately 5% in price. By the end of year 1, after dividends are reinvested and contributions are added, his portfolio sits at roughly $28,200. Sounds great, until we subtract everything else. Most of Ethan's dividends are qualified dividends, which receive favorable tax treatment in many cases. But depending on his taxable income and account type, some investors could owe federal and state taxes before they ever reinvest those dividends. If Ethan holds these investments in a taxable brokerage account, part of that $950 may no longer be available to compound. The dividend looked like income, the tax bill quietly reduced it. Lucas experiences something completely different. His $20,000 also receives another $6,000 in contributions. Instead of cash distributions, almost all of the return stays inside the companies in the index. After approximately a 10% market return and subtracting a tiny 0.7 expense ratio, his portfolio finishes the year at roughly $29,100. No dividend notifications. No quarterly excitement. Just about $900 more than Ethan. Not life-changing. Not yet. On day one, Ethan felt rewarded. On day one, Lucas felt patient. By the end of year one, Lucas quietly has a small lead. Not because dividend investing is bad, but because more of the total return stayed invested inside growing businesses. Year 3 is where psychology starts becoming interesting. Ethan has now collected thousands of dollars in dividends over multiple years. Every payment reinforces his belief that he chose the superior strategy. His annual dividend income has climbed to around $1,350 because he keeps buying additional shares, and many companies have increased their payouts. His portfolio value reaches approximately $47,000. He's proud of those growing income payments. And honestly, he should be. They're real. They're consistent. They're tangible. Lucas, meanwhile, doesn't have income to celebrate. He simply keeps buying his index fund every month, regardless of headlines. Some months he buys when prices are high. Other months he buys during market declines. He's averaging into the market without trying to predict it. By the end of year 3, his portfolio reaches roughly $50,500. Again, the difference isn't enormous. About $3,500. But something important is happening beneath the surface. Every additional dollar of growth inside Lucas's account is now generating its own future growth. Compounding has started compounding. And that's where investing quietly becomes dangerous. In a good way. Because small differences don't stay small forever. Now let's fast forward to year 5. Ethan has invested a total of $50,000 between his original investment and monthly contributions. His dividend income has grown to roughly $1,900 per year. That's about $160 every month, without adding any extra work. It feels incredible. He tells people, "My portfolio pays some of my utility bills." His total portfolio value has reached approximately $69,000. On paper, that's impressive. Sounds great, until you subtract everything else. Some of those dividends have created annual tax obligations. Some of the highest yield stocks in his portfolio haven't appreciated as quickly because companies paying larger dividends often have fewer opportunities to reinvest profits for rapid expansion. He's still building wealth, just differently. Lucas has invested the exact same amount of money. His total portfolio now sits around $76,500, nearly $70,500 ahead. He hasn't received exciting cash payments. He hasn't posted screenshots of dividend deposits online. But the gap is beginning to widen, quietly, almost invisibly. And here's what makes this comparison so fascinating. Neither investor has done anything wrong. Neither investor has made a reckless decision. They're both disciplined. They're both consistent. They're both investing every single month. The difference isn't discipline. The difference is understanding where total return actually comes from. Because in the next phase of this story, we're going to hit the point where most people stop looking. That's exactly where the numbers become impossible to ignore. If we stopped the comparison right here, Ethan would probably still feel pretty good about his decision. After all, he's collecting nearly $2,000 a year in dividends. His portfolio has grown from $20,000 to around $69,000, and he never had to sell a single share to generate cash. Lucas, on the other hand, has a bigger account balance, but no quarterly dividend notifications lighting up his phone. Depending on who you ask, each one looks like the winner. But investing isn't a 5-year game. It's a 20-year game. And this is where the story quietly changes. Let's jump to year 10. Both investors have now contributed another $60,000 over the previous 5 years. Including their original investment, they've each put a total of $80,000 of their own money into the market. Ethan's dividend portfolio has continued doing exactly what it was designed to do. His companies have increased their dividends almost every year. His annual dividend income is now approaching $4,200. That's about $350 every month. It feels meaningful. He's starting to imagine using those dividends to help pay for vacations or cover part of a mortgage payment. His total portfolio value has climbed to roughly $132,000. Again, that's a solid result. He's more than doubled the money he personally invested. But now look at Lucas. The same contributions, the same discipline, the same starting point. His S&P 500 index fund has grown to approximately $158,000. That's a difference of about $26,000. Not because he found some secret investment, not because he took crazy risks, because nearly all of the companies inside the index kept reinvesting earnings before, eventually returning value to shareholders through a combination of growth, dividends, and share buybacks. That difference starts creating its own momentum. A $26,000 lead earning another 10% annually produces around $2,600 in additional growth, city. Following year, the gap itself is now making the gap larger. That's the flip point. Early on, the dividend checks felt like proof that Ethan was winning. Now the larger portfolio quietly starts producing larger dollar gains every year. On paper, Ethan's portfolio earns around 5%. Lucas's portfolio earns around 10%. 5 percentage points doesn't sound dramatic until you remember that compounding doesn't grow in straight lines. It grows exponentially. 1 year becomes 2. 2 becomes 5. 5 becomes 20. Now let's fast forward another decade. Year 20. This is where long-term investing either rewards patience or exposes bad assumptions. By now, both investors have contributed a total of $140,000 from their own pockets. No extra savings, no inheritance, no lottery tickets, just 20 years of consistency. Ethan's dividend portfolio has become something most investors would admire. His annual dividend income has grown to roughly $9,000 to $10,000 per year. That's around $800 every month before taxes. His total portfolio value reaches approximately $355,000. If someone only showed you that number, you'd probably think the strategy worked beautifully. And honestly, it did. A disciplined investor turning $140,000 of contributions into over $350,000 deserves credit. But Lucas finishes with roughly $520,000. That's about $165,000 more wealth. Read that number again. $165,000. Same salary, same city, same age, same monthly contribution, just a different investment strategy. And here's the crazy part. Lucas never felt richer along the way. He never received those satisfying dividend notifications. Most years looked completely ordinary. His account simply compounded quietly in the background. Now, before anyone rushes to declare index funds the obvious winner, this is where we need to slow down. Because this is the part almost nobody on YouTube explains honestly. What nobody talks about isn't whether dividend stocks work. They absolutely can. What nobody talks about is which numbers people choose to advertise. Dividend investors often highlight one number, dividend yield. My portfolio yields 5%. My portfolio pays me $1,000 every month. Those statements can both be true, but they're incomplete. Let's peel back the layers. First, taxes. Qualified dividends often receive favorable tax treatment under IRS rules, but they're still taxable in many brokerage accounts. Depending on income level, qualified dividends may be taxed at 0%, 15%, or 20% federally, with state taxes potentially applying as well. Meanwhile, unrealized gains inside an index fund generally aren't taxed until shares are sold. That means more money keeps compounding before taxes are eventually due. Second, turnover. Many investors chasing high yields constantly replace stocks after dividend cuts. Every sale can create taxable events, trading costs, and the possibility of buying into another company whose attractive yield hides weakening fundamentals. The index fund barely asks you to make decisions. Fewer decisions usually mean fewer expensive mistakes. Third, concentration risk. Imagine Ethan owns 20 individual dividend stocks. If one company cuts its dividend by 50%, his annual income drops immediately. Lucas owns roughly 500 of America's largest public companies through a broad S&P 500 fund. If one company struggles, hundreds of others continue working. Diversification isn't exciting, but it quietly reduces risk. Fourth, expense ratios. This one surprises people. Many dividend-focused ETFs charge expense ratios around 0.6% to 0.0. Depending on the fund, that's still relatively inexpensive. But broad index funds like Vanguard's VOO currently charge about 0.5 REMA. Vanguard's 0.3%. A difference of only a few tenths of a percent sounds tiny. Over 20 years, it compounds into thousands of dollars that remain in your portfolio, instead of leaving it. Fifth, Opportunity cost. This is the hidden cost almost nobody includes. Suppose a company earns $1 billion. Management has two choices: pay that money out as dividends, or reinvest it into projects expected to earn high returns. If the company can consistently earn 15% or 20% by reinvesting internally, distributing cash today may actually reduce long-term shareholder wealth. That's why many of history's biggest winners paid little or no dividends during their fastest growth years. Companies like Amazon focused almost entirely on reinvesting profits for decades instead of 25, paying shareholders immediate income. Different businesses create value in different ways. Finally, behavior. This may be the biggest hidden cost of all. Not taxes, not fees, not dividend yields. Behavior. Research published in the SPIVA scorecards from S&P Dow Jones Indices consistently shows that, over long periods, a majority of actively managed U.S. equity funds fail to outperform their benchmark indexes after fees. That doesn't prove active investing never works. It simply shows how difficult consistent outperformance really is. Now imagine trying to select individual dividend stocks year after year while avoiding dividend cuts, business declines, valuation mistakes, and emotional decisions. The math gets much harder than simply buying the market. But here's where I want to be completely fair. If I only showed you the downsides of dividend investing, I'd be doing exactly what every index fund influencer criticizes dividend investors for doing. That's not useful, because index funds have real disadvantages too. Serious ones. For starters, volatility. When the entire market falls 30%, your index fund falls with it. There's nowhere to hide. Dividend investors often own mature companies that sometimes decline less during bear markets, especially businesses with stable cash flows like consumer staples or utilities. Second, income. Lucas has a portfolio worth more than $500,000, but unless he sells shares, that portfolio doesn't automatically pay his monthly bills. Ethan's dividend income arrives whether he sells anything or not. For retirees who depend on investment income, that predictability has genuine value. Third, psychology. Many investors simply stay invested more easily when they receive cash distributions. If dividend income helps someone avoid panic selling during a recession, that behavioral advantage can outweigh small mathematical differences. Sometimes the best investment isn't the one with the highest expected return. It's the one you'll actually stick with for 20 years. And there are absolutely situations where dividend investing can outperform. If you're investing inside tax-advantaged retirement accounts, where dividends compound, tax-deferred, the tax disadvantage becomes much smaller. If you're building an income-focused retirement portfolio, rather than maximizing wealth, decades away, dividend strategies may fit your goals better. If you specifically buy undervalued dividend growth companies that later increase earnings faster than expected, you can absolutely outperform a passive index. And if you simply enjoy researching businesses and have the discipline to evaluate companies objectively, individual stock selection isn't automatically a mistake. The problem isn't choosing dividend stocks. The problem is assuming dividends alone create wealth, because the next piece of the puzzle changes everything. It's the one adjustment that can completely rewrite both Ethan's and Lucas's ending. Here's where the story takes one final turn. Because if you've been paying close attention, you may have noticed something. We've been comparing two disciplined investors who both saved exactly the same amount every month. But what happens if one tiny variable changes? Let's go back to Lucas. Suppose that instead of investing $500 every month, he increases his contribution by just $200, not $2,000. Not some unrealistic amount that most people can't afford. Just another $200 per month after getting a raise, paying off a car loan, or cutting back on a few recurring expenses. That means Lucas is now investing $700 every month instead of $500. Everything else stays exactly the same. Same age, same starting balance, same investment, same 20-year timeline, at a long-term average annual return of approximately 10%. That additional $200 per month grows into roughly $150,000 to $170,000 of extra wealth over 20 years. Think about that for a second. An extra $48,000 of contributions creates well over 3 times that amount in additional portfolio value. Not because the market changed, because time changed. Compounding rewards consistency far more than brilliance. Now let's run that same adjustment for Ethan. If Ethan also increases his monthly investment from $500 to $700 while maintaining his dividend strategy, his ending portfolio also grows substantially, reaching approximately $470,000 to $490,000 depending on dividend growth, taxes, and market performance. That's an excellent outcome. In other words, the biggest wealth creator wasn't switching strategies. It was saving more. That's a lesson that often gets lost in debates about dividend investing versus index investing. People spend weeks arguing over a 1 or 2% difference in expected returns, while ignoring the fact that increasing their savings rate by a few $100s per month can create 6 figures of additional wealth. The strategy matters. The habit matters even more. Now let's zoom out even further, because neither Ethan nor Lucas has reached retirement yet. Imagine they continue for another 10 years. At year 30, assuming similar long-term return patterns, Ethan's dividend portfolio could reasonably grow into the range of $700,000 to $850,000, while producing annual dividend income approaching $20,000 to $28,000, depending on yield and dividend growth. Lucas's broadly diversified index portfolio could reach approximately $1 million to $1.2 million under the same contribution assumptions. That's not a guarantee. Markets don't deliver identical returns every year. Some decades are exceptional, others are disappointing. But historically, broad U.S. equity markets have rewarded patient investors over long periods despite recessions, crashes, wars, inflation, and countless headlines predicting the end of investing. According to data published by Vanguard, keeping investment costs low has historically been one of the few factors investors can actually control, and even small differences in fees compound into meaningful differences over decades. Likewise, S&P Dow Jones Indices PIVA reports continue to show that most actively managed U-fees equity funds underperform comparable benchmark indexes over long investment periods after accounting for fees. Those aren't opinions. They're simply published data. Now, does that mean every investor should ignore dividend stocks forever? Absolutely not. In fact, for many people, the smartest answer isn't choosing one side. It's combining both. Here's a simple playbook. Step 1. Build your foundation with a low-cost diversified index fund. That gives you exposure to hundreds of profitable companies with minimal expenses and broad diversification. Instead of trying to guess tomorrow's winners, you own almost all of them. Step 2. Once that core portfolio is established, decide whether income is actually one of your financial goals. If you're 25 years old and saving for retirement 40 years away, maximizing total return may deserve more attention than maximizing current dividend income. If you're approaching retirement and want dependable cash flow, gradually increasing your allocation to high-quality dividend-paying companies may make much more sense. The strategy should match the objective, not the latest trend. Step 3. Revisit your contributions every year, not your portfolio. Your contributions. Whenever your income increases, ask yourself one question. Can I invest another $50, another $100, another $200? Most people spend hours researching investments that might improve returns by 1%. Very few spend 5 minutes increasing automatic contributions. Ironically, the second decision often has the larger impact. Now let's go back to where we started. Ethan and Lucas both walked away, thinking they made the smart play. Ethan believed his growing dividend checks proved he had built the superior portfolio. Lucas believed his larger account balance proved index funds were the only logical choice. Neither one was completely right. Neither one was completely wrong. Because the real lesson was never about choosing sides. It was about understanding what you were actually measuring. If your goal is maximizing long-term wealth, total return is the number that matters. Not dividend yield by itself. Not portfolio income by itself. Total return. If your goal is reliable cash flow in retirement, then dividend income becomes much more important. Different goals, different scoreboards, and that's the part social media rarely tells you. One creator shows a screenshot of receiving $3,000 in dividends. Another shows a chart of the S&P 500 crushing everything else. Both screenshots are real. Neither tells the complete story. The real trap isn't dividend stocks. The real trap isn't index funds. The real trap is making the decision based on hype, headlines, or someone else's opinion, instead of running the numbers for your own situation. Because once you actually include contributions, taxes, fees, diversification, behavior, time horizon, opportunity cost, and total return, the answer becomes much more nuanced than a catchy thumbnail or a viral tweet. And if you're wondering what happens when you combine both strategies, using index funds to build wealth first and dividend investments to generate retirement income later, that's a completely different conversation. One we'll definitely break down in a future video. So before you make your next investment decision, ask yourself one question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.